Let's talk a little bit about valuation. This is our entrepreneur series, business plan basics, and I want to talk about valuation, which is typically I put an implied valuation section in the executive summary, and I talked a little bit about that in the little video segment I did on the executive summary. I'm not going to dig into the actual methods of valuation. There are a bunch of those. You can kind of pick whichever one you want. I'll do another segment on that in the future and dig into the math behind it, get a little more in detail. But right now I just want to talk about pre-money and post-money and why it's important to understand this, and also why it might be a good idea not to include too much data depending on where you are in the process of building your company. If it's a brand new startup, it's especially difficult to come up with a valuation, especially pre-money. This is a very tricky thing, and a lot of people don't understand that you can sort of paint yourself into a corner if you include a lot of information about valuation, because there are implications. For example, if you're asking for a certain amount of money and you say that you're willing to give the investor a certain percentage of the company for that amount of money, most people don't understand that by definition you're establishing what your pre-money and post-money valuation is by making that statement. And let me explain what I mean by that. Let's say you're looking for $1 million and you're willing to give up a certain percentage of the company to get that $1 million. Let's say just to make it simple, let's say that you're willing to give the investor 50% ownership of the company for that $1 million. Well, what you're saying then is that your company pre-money, before you get the $1 million, is worth $1 million. So if this is a pure startup, and you're saying by definition, if the person gives you $1 million, your post money would be $2 million, because that $1 million it represents 50% of the value of the company. Just take $1 million and divide by 0.5 or 50%, and you'll see what I mean. That means that post money, meaning after the person gives you the $1 million, the company is therefore worth $2 million, because the $1 million represents 50% of the total value of the company. The total value then, because of the math, is $2 million. By definition, that means that pre-money, what the value of the company is before they give you the $1 million, is $1 million. That 50% that you own after they give you the $1 million. So the problem comes in, if you say pre-money is $1 million, then you have to justify why the company's worth $1 million. Now, for some entrepreneurs, that's not a big deal. Maybe they've invested a lot of money in a product, for example. Maybe you've got patents. Maybe you have already put together a manufacturing facility and you bought a bunch of equipment, and you can therefore justify this $1 million valuation. If it's a pure startup and you just have an idea for a company, for example, and you really haven't invested any hard assets into the company, it's your blood, sweat, and tears, human capital kind of investment on your part, that doesn't usually resonate well with investors. It may very well be worth that much to you, or theoretically speaking, but to an investor, it's very easy for the investor to beat you up on that number and knock you down and say, you know what, it's not worth $1 million, your pre-money valuation. I don't see the justification for that. To me, it's only worth $250,000. So if the post-money value therefore is the $1 million they're investing plus the $250,000 pre-money valuation, then the total company post-money is only worth $1.25 million, which means that their $1 million investment, instead of being worth 50% of the company, is worth a whole lot more, and you're basically giving up a lot larger percentage ownership in the company than you really want to. So again, we can talk about ways of coming up with these valuations, but the bottom line is, especially on a startup, if you state in the business plan that you're willing to give the investor a certain percentage of the company for the upfront investment that they're expected to make, by definition you're establishing pre-money and post-money valuation, and you could paint yourself into a corner with that, to where then you get in a debate with the investor about what pre-money should be, and a lot of times that's a losing battle for the entrepreneur. So at some point you have to have this discussion with them anyway, and you're going to have to negotiate that. But sometimes it's better not to include that information in the business plan right up front. for example, some readers may read that and they may make the calculation in their mind and say, you know what, if I'm only going to get 50% or 40% for my $1 million investment, that means that, you know, pre-money is this amount, and I don't think the company is worth that. It's just an idea, so I'm not even going to talk to this entrepreneur. And you miss an opportunity, whereas that investor otherwise might be really interested in the business concept and interested in making an investment. They just don't like the pre-money valuation, and therefore they walk away before you even have a chance to sit down and talk with them about it. And you miss an opportunity to get an investor to put money into your company. So most of the time when I write business plans, I advise the entrepreneur not to include that information. I do an implied valuation, just showing what the company theoretically, based on the financial forecast, could be worth in the future. That's a completely different story, but it does help to show the investor what the potential profit would be on their investment. But I don't get into pre-money and post-money valuation, specifically stating if you invest $1 million in this company, you're going to get 40% of the company up front. Those kind of discussions, in my opinion, are better done face-to-face in a negotiated format rather than a stated thing in the business plan. But that's debatable. A lot of people like to put that in. For example, an entrepreneur may have just made up their mind, I'm willing to give up 40% of the company for the $1 million or whatever amount of money I need. That's the max I'm willing to give up, so that's what I'm going to put in the business plan, and I'll start with that. And anybody that's not happy with that, well, I don't want to talk to them anyway. I don't think that's the right approach, but for some entrepreneurs, they're very passionate about their business, and that's how they feel, and that's fine. But if someone asks me what to do, I tell them don't include it.